First off, I just want to thank Trisha for pushing me to organize this. We've been doing a lot of work together. She said, you have to do a webinar on student loans. It's just so confusing. People need the clarity to kind of see what they don't see regarding student loans. And she thought I was the one to give it. So I really appreciate her pushing me to do this. Her background, she began the journey preparing taxes at H&R Block, and then discovered that so many issues could have been avoided with just a little more planning. So she went on to earn her enrolled agent status with the IRS, and then on to become a certified financial planner. So in her previous career as an engineer by personality and training, she likes to think that she can help people engineer a better future for themselves. So she founded her company Mindful Financials in 2011 and enjoys doing those math problems with her clients every day. Trisha, how are you?
I'm good. Thank you. Thank you, Justin, for doing this. I think we're both so excited to get this information out. Just a few pieces about Justin. He is also a certified financial planner with Personal Wealth Strategies. He is the first advisor in the state of New Jersey to obtain his certified student loan professional designation, which is super awesome. He has been dubbed the student loan wizard by his clients. He also is the author of an upcoming book, I Am a Doctor, Now What? The Essential Financial Moves Every Medical Resident Needs to Make. He also serves as director of Gen Ed for the Financial Planning Association of New Jersey. And on top of all of this, he and his wife are the proud parents of 8-year-old boy and girl twins. So I don't know how you are standing, but yay, you.
Yes, 1 boy, 1 girl. It has been an incredible adventure so far this year. A lot happening in 2022, personally, and a lot with student loans. And so that's why we're here tonight to discuss student loans. So I'm really happy. Trisha, thank you so much for that introduction. We do have a Q&A feature. So if you, because we may not see in the chat, we're going to try to monitor that as well. But really, if you have specific questions, feel free to start plugging those into the Q&A feature right now, so that we can get those answered tonight. I plan on going for about an hour, but this is a lot of material. So if we have questions, I'm willing to go probably till midnight. But no, we'll see how that works. So I want to start kind of with the most recent history, and that is with the new Biden administration announcement of last Wednesday, kind of announcing a sweeping loan forgiveness program. And so many of you seen this on the news, $10,000 forgiveness of student loan debt for a borrower. Now, additional $10,000, so up to $20,000 if they also qualified for a Pell Grant. And one of the biggest questions that we've been getting is, how do you know if you've qualified for a Pell Grant? And the easiest answer is to log into your studentaid.gov website, which has ironically crashed several times over the last week with the demand of people rushing to go see if their loans were immediately forgiven, which definitely was not the case. But they can go and see in your loan history whether or not you did qualify for a Pell Grant, because many people I've talked to don't even remember. And so that's one of the ways. So that's how you can qualify for $20,000. Now, in the intro or the invite for this call, I said up to $30,000 per student. And that is actually if you include Parent Plus loans as well. So Parent Plus loans are separate. So if the parent borrowed money under the Parent Plus loan program for the student that also qualified for a Pell Grant, then you could actually get $20,000 for the student and then $10,000 for the parent. Now, the parent, if they had multiple children, still only get the $10,000. So it's a little bit confusing there in terms of the qualifications. Now, something else that's very important that you need to qualify for, it's going to be based on your income, and you have to be under $125,000 for single individuals and $250,000 for married couples. Now, there hasn't been clarification on this yet, but we believe that it's going to be a cliff, meaning that if you're at that $1 over that 125,000, or actually probably at 125,000 since it specifies under. So 124,999, you qualify for forgiveness. At 125,000, you lose forgiveness. And so it's a hard cliff there. So pretty big penalty for that $1 extra of income. They did further clarify if you're head of household, they will count you as 250,000 of income if you're under that filing status. Now, how they look at income, they still haven't released the specifics of that yet. But we believe, based on kind of what they have done prior to all of the different student loan things in the past, that it will be based on your adjusted gross income, which is, if you look at your 1040, Trisha can correct me if I'm wrong here, I believe that's line 11 for both 2021 and 2020. So line 11, adjusted gross income. So that's the number that we're looking at. And I said 2021 and 2020, and it's actually either or. So if your income was under in 2021 or under in 2020, you would qualify for forgiveness. It doesn't have to be both. So if your income was really, really low in 2020 and you were over that threshold, the income threshold in 2021, it doesn't matter. It looks like you would still qualify for forgiveness because you had the income qualifications for one of those 2 years. Now, I said I would go through some planning aspects as well. That's a little bit more nuanced than what you might see on the news. And unfortunately for most people, your 2021 and 2020 taxes are set and filed and done with. There's a small subset of people that may be on an extension and have not filed yet. And if that is the case, you may have the opportunity, if you're close and on the border, you may have the opportunity to help lower that adjusted gross income by creating some type of self-employed retirement account or some other maneuvers. Also, if you're married, you could also consider filing separately. If combined, you're over 250, but separately, you would be under that 125 threshold. So those are the two kind of after the fact strategies that a handful of people may be able to take advantage of if you have not filed your 2021 taxes yet. But if you've already filed the 2021 and 2020, those incomes are set. You can go check your adjusted gross income there to see if you meet the income threshold. In terms of the cancellation, one of the things that I want to, and a question came in, thank you so much, Whitney, what are the tax ramifications of loan forgiveness? So in looking at the tax ramifications federally, under the American Rescue Plan passed by President Biden last year in 2021, he made federally the loan forgiveness tax-free through 2025. So it was a temporary assignment. A lot of people saw that at the time and said, oh, hey, he's probably setting up maybe to do some type of forgiveness. But so he made it any type of student loan forgiveness tax-free federally through 2025. Now, however, that does not mean that there isn't potential state ramifications. So I'm in New Jersey. New Jersey has come forward and said, specifically, since it's a cancellation of the debt, that would not be taxable income in the state of New Jersey. But there are about 13 states where this student debt cancellation could be taxable. Of those 13, 3 that I know of have come out and said that they're going to adjust their tax laws and make it non-taxable. Those states are New York, Pennsylvania, and Virginia. And then I've seen one state come out to say they definitely are going to tax the student debt cancellation, and that's Mississippi. Just to round it out, the other states that could potentially tax the student loan cancellation are Arkansas, Hawaii, Idaho, Kentucky, Massachusetts, which I know Trisha's from, Minnesota, South Carolina, West Virginia, and Wisconsin. So yes, federally, you're safe, but the state, if you're in one of those states, you want to take a look at that and see whether or not they're going to maintain their current tax laws where they could tax that student debt cancellation. What if a student didn't qualify every semester for a Pell grant? That's an excellent question. We haven't gotten specific clarification on this, but from what we see, it doesn't matter the amount of Pell grants that were issued. If you had any amount of Pell at any point in time, that would be the trigger, and so you would qualify for the 20,000 up to 20,000, regardless of the the amount of the Pell. So great question there. Again, further clarification could come from that, especially if the Republicans challenge the ruling. So that's one of the biggest risks here that I do want to mention right now is, well, one, there's a lot of fine print details that still have to be released. There's also a significant chance that Republicans who oppose the plan will potentially try to stop its implementation. And that would be done through legal challenges and through the court system. So the ultimate outcome may actually be determined by the courts. So this is far from a guarantee, even the cancellation in and of itself. So I know that the Biden administration has had their attorneys look into this, and they clearly think they have the legal authority to be able to do this. But it will eventually be up to the courts if the Republicans choose to take that there. So that's kind of the big sweeping announcement in terms of the cancellation. You also got a final extension of the pause for federal student loan payments. That was through the end of this year, December 31st, 2022. Now, they said this is the final extension, and I think it will be, but I've also said that before when they've had the final extension for January of this year to a final extension to a final extension. So I don't know if we can believe in terms of how final this actually is, but as of right now, those 0% interest is extended through December 31st, 2022 to give them time to do these changes. And then the payments will resume on January 2023. And probably towards the end of January. I don't think they're going to have enough time to restart actually at the beginning. I mean, we've been on a pause now for almost 3 years, which is kind of ridiculous to say out loud. But that is it. Anonymous attendee, do you have to have federal loan for it to be forgiven? Yes, it is only about federal loans, and actually more specifically, only federal direct loans. Now, if you do have an older type of loan, an FFEL loan, it could be federally held, which would automatically qualify under this new announcement. But if it is not federally held, you will want to consolidate that loan into a direct loan. So then it would fall under the ruling. There's a little bit of a gray area there, whether or not if you do that even right now, it will qualify. I think they will probably pull it in based on what they've done, but no guarantees there that those older type of FFEL loans that weren't issued directly from the Department of Education. They were issued from private banks and institutions, and they were backed by the Department of Education. So it was a different setup, and those loans would have been prior to 2010. So some older loans, that program stopped in that year. Now, some of the other changes that occurred through this announcement is the public service loan forgiveness. They changed some of the provisions ongoing, but there's something even larger with public service loan forgiveness that we will talk about later later in this call in terms of the limited waiver, but I'll just kind of save that for a little bit later. And then there's the announcement of the creation of a newly proposed income-driven repayment plan. So this is just, again, a proposal, so nothing official yet, probably won't be if available until July of 2023, I would say at the earliest. And this is the plan that will limit borrowers' payments if you only have undergraduate loans to 5% of the borrower's discretionary income. And that would forgive, and then they would also have a small amount of forgiveness of loans less than $12,000 after 10 years of payments. Now, it gets a little interesting if you have graduate loans as well. So if you have all graduate loans, it goes all the way up to the 10% of the borrower's discretionary income, which is where most of the income-driven repayment plans are set right now. But if you have a combination between the two, it looks like they'll do a weighted average. So just to make it easy for math in my head, if you have 50% undergraduate loan and 50% graduate loan, your percent of discretionary income would be 7.5%. Another thing kind of deep in this new announcement is how they calculate discretionary income. For most of the other plans, it's 150% of the federal poverty guideline, which if you're in the lower 48 is the same number for everywhere. It's different in Hawaii and Alaska, so you want to look up that number. So 150% for current plans. It's actually 225% for this new proposed income-driven repayment plan. And that would actually, so by raising that, it will lower the eventual payment calculated. So overall, this new plan, if passed as is and done as is, looks like it would probably replace and be the best option for most borrowers, depending on the qualifications than any other plan. But they probably wouldn't eliminate any other plan because that's not precedent. Typically, why we have about 5 different income-driven repayment plans is every time they've come up with a new one, they've just added it to the options. And so that's why you kind of get this huge, big options and a lot of confusion. All right, let's take a breath here and look at some questions. Do we need to apply for the forgiveness or is it automatic? Phenomenal question. For a lot of borrowers, it will be automatic if they have your income on file, meaning if you've been on an income-driven repayment plan, they will most likely have your income on file. However, if you have been in the pause since March and not recertified your income, their last filed tax return would have been from 2019. So they probably will, and they're going to come out with a form for this, which you're going to watch out for. It's not out yet. It'll come out, they're projecting mid-October, a form that you'll be able to apply with to verify your income from either 2020 or 2021. And then they will process that and the loans will be forgiven before the end of the year is kind of the plan before the loan repayments start in January. So you will have to most likely do something, which you definitely want to pay attention to because you don't want to not do it and miss out on forgiveness. So you want to pay attention very closely for that paperwork when it gets its way out. Can I be refunded on payments I have made towards my loans during the pause period? Taylor, bingo, phenomenal question. So one of the planning aspects, and I get and complaints that I've heard is, Justin, I paid off my loans already during the pause, during the pandemic. I was responsible. Now they're announcing forgiveness and I can't get it. Well, what the Department of Education will actually allow you to do, and this may be a good idea too, regardless of if you qualify for forgiveness or not under this, we'll talk about that later as well. If you can request any payments that you've made after the pause. So the pause started March 13th of 2020. Any payments that you've made, you can request a refund from your servicer. And so requesting the refund from the servicer, it's probably going to take a long time right now because there's probably a lot of people that are doing it, or if they're not, they're going to start doing it. The problem with it is there's no guidance or clarification yet whether or not they'll actually count that now towards your forgiveness. I've seen a lot of posts online saying that that's a definite result, and I wouldn't be so sure of that. It should work that way, but until we get clear guidance from the Department of Ed or the president and more of those details, we won't know exactly what they're going to do if you get the refunded payments. But with that being said, there's no downside to requesting it, because if you get the money back, you'll have the money and then you'll have the loan again, the student loan again. It's still going to be 0% interest, 0 payment through the end of the year. And if something doesn't happen and it doesn't get forgiven, you can just keep that money and pay it back. And the only thing you lost was your time. So there's no real cost besides your time for trying to pursue that strategy. So that's just something that you have to decide if you want to take up that time or not. What is a direct federal loan? Do we know which banks qualify? So a direct federal loan actually is direct, meaning that it's direct from the federal government. So if you check and log into that studentaid.gov website, all of your loans, including the direct and FFEL, the Family Federal Education Loans, those will appear there. And you'll also see your Pell Grant there. You'll also see any Perkins loans there, which is another older type of loan. So the only loans are those direct loans that you can be sure qualify. And so that's what you're going to want to log in. So if you're with a bank, chances are for example, a PNC, if they have your loan, it could be a private loan, which don't qualify at all, or it could be one of those older FFEL loans that are actually owned and serviced by PNC, but backed by the federal government. So in order to do that, you have to do a direct consolidation, which they'll allow you to do. And like I said before, it's still questionable whether or not they will actually allow that forgiveness after that consolidation. But that is that's what we know right now.
Then you have a question in the chat. Private medical school loans through the medical school, once they have been deemed defaulted and written off by the school, does it benefit you to even attempt to pay those off greater than 15 or more than 15 years later?
That's a very specific question, which may depend on your certain situation. So if you have the ability to repay, you may want to restart that. But if they have written off the debt and it's such a long time ago and it's not reported on your credit report, then there's probably no need to reawaken that beast and pay it off. But that's going to really be based on your own specific situation and how you are, whether you could repay it even if you you wanted to. Thanks for that. All right, so I want to get into that Pslf limited waiver, which I teased a little bit at the beginning, because that is really urgent right now, meaning that you have a deadline, October 31st of this year, 2022, to get those loans right. That was not extended as part of this announcement from President Biden. They extended some of the features that were included in the Pslf limited waiver. For example, they will allow payments to be counted while you're in forbearance or deferment in some certain situations, like you're in the Peace Corps or whatever, or military deployment. They'll also kind of allow lump sum payments to be counted, or give you credit for late payments, because before, let's say before October 6th of 2001, before that was when the Pslf limited waiver was announced, in order to qualify for public service loan forgiveness, you had to check off a lot of boxes. You had to have the right type of loans, be in the right type of repayment plan, be working for a qualifying employer, have those payments be on time. And so all of those check boxes needed to be marked, and most of them, for most people, weren't. So when the initial phase of people started to become eligible after 10 years of service for public service loan forgiveness and started to apply for it, they had a 99% rejection rate. So meaning 99% of people who thought they qualified for public service loan forgiveness actually did not, because they didn't check all of the boxes, because the rules were very, very specific, and a lot unknown to the servicers. And the servicers absolutely did a very poor job of communicating that to the borrowers. But regardless, it is a confusing program, and a lot of people were rejected. So kind of under the framework of the pandemic, using some stipulations from the HEROES Act of 2003, the administration felt that they had the authority to help push through this limited waiver. And what the limited waiver allows you to do is to go back in time and count these previously non-qualifying payments, and turn them into qualifying payments, assuming that you do the proper thing with the loans right now. And so if you still have direct loans, everything that I'm saying right now is for direct loans. If you have direct loans, you're probably okay. But there's some planning strategies around there, which I'll go into very soon. The direct loans are okay, but you want to look at them and see if you can pick up any past payments where you potentially might have been on a repayment plan that did not qualify. So a qualifying repayment plan is the standard 10-year repayment, which if you were under the standard 10-year for 10 years, the loan's paid off anyway, so that doesn't make much sense, or an income-driven repayment plan. And so that would be income contingent repayment, income-based repayment, pay as you earn, revised pay as you earn. So those plans all count as the qualifying plans. But if you made it under an extended repayment plan, a graduated repayment plan, an extended standard plan for like a 30-year after consolidation, all of those plans did not count for public service loan forgiveness, but under the limited waiver, they will. And so what you need to do in order to help qualify for that is you'll want to resubmit your public service loan forgiveness certification forms and report all of the time and all of the history that you have worked in a nonprofit. So based on kind of governmental statistics, about 25% of people work in the nonprofit, governmental agency, hospital arena. And so this is probably affecting 1/4 of the people on this call. And so in looking at that, you want to make sure that all of your loans right now are direct loans. Now, an interesting, I call it a case study of somebody that I just was working with. Hopefully they're on the call. Hello. They had $178,000 of student loan debt as a social worker. And they just finished their graduate degree in this year. They graduated this year from their graduate degree. So they took out their most recent student debt in January of this year for this that semester. They had loans actually from undergrad, which were from 2004 to 2009. They consolidated those loans to direct loans because those were FFEL loans. They consolidated those loans to direct loans, and those loans actually were qualifying for public service loan forgiveness along the way. But these most recent loans that she took out for grad school from 2019 through 2022, that was about $104,000, where the loans from undergrad were about $74,000. So that's how the total of $178,000. Very important, under the limited waiver, so until October 31st, 2022, when you consolidate loans, you will receive, this is important, the longest payment history of the longest loan that you consolidate. Before the waiver, once you consolidated, you're done. That reset the clock. You have 120 payments left to forgiveness. So that was a big mess up if you had done that before the limited waiver. Now, under the limited waiver, if you consolidate loans that have different payment histories, in that new consolidated loan, they're going to take the one with the longest payment history. I want to take a quick footnote right here. When I say consolidation, I'm being very, very specific. That's different than a refinance. So a lot of people in loan land have consolidation of your debt and refinance of your debt kind of as the same thing in their language. When you talk about student loans, they're actually very, very different. And so in looking at that, a consolidation, you're going from multiple loans to a single loan, or maybe two loans if you have both subsidized and unsubsidized loans federally. With a refinance, you go to one loan, and it's with a private carrier that's private. They're no longer federal, and you only would do that if you could qualify for a lower interest rate and you're okay with foregoing all of the federal benefits. And so you want to be very careful in analyzing that refinance. So consolidation is what I'm talking about here. And the consolidation, they take that longest repayment history. So if you think about the case study that I was just talking about with the social worker, $178,000 in debt, $104,000 of her loans wouldn't have qualified because she had just taken them out for graduate school. $74,000 have 10 years of payments already built into them that she just hasn't filed for her public service loan forgiveness for that yet. So what we were able to do is do that consolidation, and now it's going to be one loan of $178,000 with the payment history of the longest payment history. So now that's consolidated. We've submitted the public service loan forgiveness form, and so she's going to get those loans 100% wiped out, all forgiven, even though she just took the most recent one in January of this year. And so that's the power of the limited waiver right now. And that is what a lot of people will be missing out on if they don't act by October 31st of 2022. Because once you pass that date, if you do the consolidation, you're going to be under the old rules, and the consolidation would reset the clock at that point in time. So that would be suboptimal, obviously, to do. Another kind of case study, because one of the themes that I've been hearing from a lot of people is that, you know, this is really helping the cancellation of the 10,000, 20,000 is really helping the lower income people, which I believe it definitely is. But the public service limited waiver is helping everybody, but I believe it is getting disproportionately taken advantage of by the higher income people, because they're allowed to hire people like us. They have the money to hire people like us to do their planning. I was meeting with a surgeon out in the Midwest who's making, buco bucks, almost seven figures a year. And it was just after the Biden announcement last week. And he mentioned he had $40,000 of student loans and joked to me that, well, I don't think anybody's going to be forgiving them. I don't qualify based on income. I said, well, let's take a look. So they were their older type of loans, FFEL loans. And he has been working in a hospital setting for more than 10 years. And we're going to do the same thing. We're going to consolidate those FFEL loans, apply for the public service loan forgiveness, and get his 40,000 wiped out. And so that's kind of skewing on the, ridiculous. I mean, he makes almost $1 million a year. He could pay off the 40,000, but why would he? He's taking advantage of the rules that are available. And so when people say that, the billionaires get all of the tax breaks, well, they just don't get that given to them. They hire expensive attorneys and planners to help them qualify and that know the rules to help them pay the least amount of tax possible. So what I'm trying to do with this webinar is give the information out, blast it out. Hopefully you're sharing this with all of your friends to give that knowledge, because I want you to have the same advisory that those billionaires have, and you can get the maximum amount of forgiveness that you're deserved by following all of these different rules and knowing all of the different rules. And so that's why I wanted to be very, very intentional to do this tonight. And I really appreciate Tricia, who really pushed me to do this. I mean, she has referred so many clients to me to do their student loan plans, and everyone that I meet has just been over the moon with Tricia and her work, and is just amazed by her. So it's amazing and really, really good to hear that from fellow planners.
A couple questions in the chat.
Yeah.
I paid for my niece's, from Cheryl, I paid for my niece's education. However, I don't claim her, so none of the parent part applies to me. Would it apply to her parents? She's been on pause for repayment and her loans total under 10K.
So it would apply to the parent, assuming that the parent's income qualifies. It would apply to the student, assuming your niece, assuming that their loan, their income qualifies. The one sticky part, if they're if the student, and this does affect by some of the questions that we get, and I don't know if it's in the queue. Does it affect current students? The answer is yes. So any loan made prior to June of this year, 2022, does fall under this, the forgiveness. But current students, if they don't have an income and they're claimed as a dependent, it goes to the parent's income. And so if your parents are over the income, you would not qualify for the forgiveness, because obviously students are assumed to have no income. And so in this situation, the parent, depending on their income, could have up to 10,000 of the Parent Plus loan canceled, and the student could have up to 20,000 if they qualified for a Pell Grant and their income qualified. So hopefully that was specific enough where it answered that question. Another question coming in: my loan was transferred to Mahila from FedLoan. They've not created an account. Should I do that before filing the application? So FedLoan to Mahila. So that is a completely normal transfer. FedLoan exited the servicer business. And FedLoan, just as a side note, was the sole servicer of public service loan forgiveness. So if you had filed any type of public service loan forgiveness certification form at all, your loans would have been transferred to FedLoan. Now, FedLoan leaving the business, that's all going to be with the new Mahila. And I call it Mahila. Some people say Mahila. I don't know what the actual terminology is. We've all been just reading it and saying it out loud. I don't know the proper way to say it. But that's what this servicer is. And so that's a completely normal transfer. What you'll want to check before you file any paperwork is looking at within the loan history of your specific loans, whether or not they will qualify or how many they have if you're in a public service route. If you're not in a public service route, don't worry, we have an option for you for the other 75% of you on the call. So stay tuned for that. But specifically, the most soonest deadline is that October 31st, and that is for those in public service. So what you want to do is verify that all of your payments have the same schedule. If they don't, you want to consolidate them first to get them all on that same longest repayment history. And then you're going to want to file for the public service loan forgiveness, trying to capture all of your past payments. Another important thing is you don't have to have the 10 years of payments satisfied right now. If you do, that will eventually lead to 100% forgiveness under the public service loan forgiveness. If you don't, let's say as an example, you only have 8 years towards your repayment. Well, and let's say 8 years for some loans and extreme example, 2 years for other loans. You consolidate those loans. Now you have the one direct loan that has now 8 years of payment. So you've aligned that. You file for the public service loan forgiveness, the certification. Now you have that saying you have the 96 payments or whatever that is, quick math in my head, for 8 years times 12. And then you would continue to, you would be now on the right path. So you have to do that all before October 31st. Then afterwards, you have to just make sure you continue to follow the rules, and then they would eventually be forgiven after the 120th payment, which you would then have to file for. Another caveat is, so we talked about before how you can request a refund from your servicers for any payment made after March 13th of 2020. That also will be helpful if you're going towards public service loan forgiveness. So if you're thinking about if you are on the path towards public service loan forgiveness, there's no reason for you to have paid any money during this time whatsoever, because all of these months count towards public service loan forgiveness. So although we haven't paid for almost 3 years, that 3 years of time, assuming that you're working for a qualifying nonprofit, governmental agency, et cetera, count towards your 120 payments of public service loan forgiveness. So meaning that you overpaid, you request a refund, you get that money back, and then you'll just eventually, once the repayments start back up, you'll pay the least amount possible. And under, you pick the correct income driven repayment plan, paying the least amount possible, getting the most forgiven. So any payments that you made during this and you eventually qualify for any forgiveness, you would have paid them for nothing. So you might as well request that refund and get money back. So now I'm going to kind of shift in. I know we still have a lot of questions piling up, 17 questions. It's incredible for the over 57 people on this call right now. Okay, income driven repayment now. So we've been focusing on public service loan forgiveness repayment, which has a 10-year forgiveness schedule. There's also a long-term forgiveness schedule for those under an income driven repayment plan. And those income-driven repayment plans are, again, income contingent repayment, income-based repayment, and there's actually 2 versions of that depending on when you took out the loans, pay-as-you-earn and revised pay-as-you-earn. Most of the schedule for the ones you would select has a 20-year long-term forgiveness or a 25-year long-term forgiveness. So under the 20-year long-term forgiveness, you pay under that income-driven repayment plan for 20 years. The loan is forgiven at the end. The difference between that method and the public service loan forgiveness method, besides being much longer in terms of its payments, the forgiveness of public service loan forgiveness is tax-free, whereas right now, after 2025, assuming that they don't extend this provision that allows for tax-free student loan cancellation or forgiveness, assuming they don't extend that, the forgiveness at the end will be taxable as ordinary income to you federally. So that's the biggest difference between the two. But assuming that you've made payments under an income-driven repayment plan, you only have to pay for 20 years, and the rest of the balance will get forgiven. Now, there's some preparations you should probably be doing to pay off the tax bomb, because if you get $300,000 forgiven and you owe $100,000, 30% in taxes on that, you owe $100,000 in taxes. That's not going to be a very pleasant bill you'll want to pay in a lump sum. So you definitely want to do some planning if you're planning to pursue this strategy. But paying $100,000 is a lot better than paying $300,000. So I do that exchange every day. We're also under, so I mentioned the Pslf, Public Service Loan Forgiveness Limited Waiver. We are also under a income-driven repayment plan waiver as well. Now, this hasn't been as clearly defined as the PSLF waiver, because for the PSLF waiver, the Department of Education has issued many FAQs, kind of clarifying things. So we're very, very clear on public service loan forgiveness waiver and how that works. The income-driven repayment waiver, we still have not seen, as of the last time I checked, an FAQ for that or any type of clarification. But we still have more time for that income-driven repayment waiver until the end of the year, December 31st of 2022. And so if you are do not work in a nonprofit and have a relatively low income relative to your student loan debt, you're going to want to look seriously at this long-term forgiveness. Now that pairs well with the new income-driven repayment plan as well, because if you can now limit your payments even further under that plan and still get the forgiveness after 20 years, that would be awesome, I believe. And there's the one other stipulation in the new announcement is if you do have a low amount of debt, under $12,000, your final balance would actually get forgiven after 10 years of repayment in the new income-driven repayment plan. So that's kind of a caveat within the new bind announcement within the income-driven repayment plan. All right, so let's get to some questions now. If you qualify for $20,000 under bind's forgiveness, but only owe $12,000 for undergrad loans, what happens to the difference? Nothing. You just get $12,000 wiped out. There, you don't get any extra. Currently in grad school with direct loans, can the $8,000 be applied there? So the Biden forgiveness plan is going to lump all of the borrower's debt into one bucket. So if you have undergrad and graduate loans, assuming those graduate loans were taken out prior to June of this year, that they're all going to qualify. So even if you only had $12,000 of undergrad and then $8,000 of grad, and you qualified with a Pell Grant undergrad, you would get the $20,000 forgiven. So thanks for that question. Are all loans forgiven after 20 years of paying? Maybe. If done properly, yes. And so in looking at that, you have to be, depending on if you have undergrad and graduate loans, and depending on which income-driven repayment plan you're in, you would want to choose the one where you have that 20-year repayment plan. Some force you into a 25 years of repayment. So for example, revised pay-as-you-earn specifically, it is a 20-year forgiveness schedule for undergraduate only loans and 25-year forgiveness schedule if you have any graduate loans. Revised pay-as-you-earn is also probably suboptimal for that, especially if you're going to have drastic increases in income, because there's no eventual payment cap with revised pay-as-you-earn. Whereas with pay-as-you-earn, eventually you're going to be capped out in terms of your payment, no matter how high your income is. So that may help you qualify for more forgiveness under that income-driven repayment plan. All right, what is the deal with the 10-year forgiveness? I think I answered that. So if you want to repost something with a little bit more clarification about specifically what the question is, I'll be happy to advise on that further. If one would only qualify for public service loan forgiveness in 4 or more years, is it worth it to consolidate student loans now? Yes, because, or should caveat, most likely yes, especially if your student loans have different repayment histories. And so you're going to want to check that closely. So it probably will make sense to consolidate. The one downside of consolidating right now to have things qualify is you're going to have to recertify your income, which is probably higher than what it was when the pause started. So just to kind of lead into that, when repayments restart in January, I'm going to assume they do, in this, they're being truthful to say this is the final pause. When the repayments start in January, that repayment is going to be based on your last filed income. So during this whole time, and there was some controversy here where things went out saying you needed to recertify your income when that was absolutely false. So assuming that you didn't recertify your income voluntarily during this time, the payments when they restart will go back to your payments before the pause in March of 2020. And so let's just say that you were a first-year intern resident at that time in 2019, and you filed based on your 2019 taxes while you were still in medical school, which would have had a 0 income. So your income-driven repayment plan would actually be 0. And so you would have paid 0, then the pause would have happened in March, and you would have still paid 0 with 0% interest all through this time. And now in January, when the payments restart, assuming you didn't recertify your income, those payments would still be zero until you eventually would have to recertify your income, which would be in May at the earliest. And that may shift too, depending, because it's been consistently shifting as they've been extending. So don't quote me on the May, but it will not be immediately where you'll have to recertify. So at least still be able to take advantage of the zero, even though your income is much, much higher at this point in time. Okay, so do you know if nursing student loan from HRSA qualifies for loan forgiveness / income driven? If it is a federal loan, I believe just not a direct loan. When is good time to do consolidation during deferment? Okay, make sure you leave this question up here for a little bit. I want to soak this in. So yes, federal loans. So if they're not a direct loan and they are a federal loan, you can consolidate them in to become a direct loan so that they would qualify for the different loan forgiveness and income driven repayment plans. And so that the answer is yes there. All right. Now this is for this next announcement here. Is if you're a parent and you have Parent Plus loans and you are working for a nonprofit or governmental agency. Right now, if you have Parent Plus loans, they do not qualify for most of the income-driven repayment plans. Actually, they don't qualify for any. You have to consolidate them once in order to qualify for income contingent repayment, which is the least favorable repayment plan out of all of them. However, if you've been working in a nonprofit, and you do this all before October 31st of 2022, which this takes some processing and we're running out of time to do it. But this should work and you should have enough time if you start right now. You take the loans and let's say you have 4 Parent Plus loans, one for each year that your child went to school. And you in order to have them a consolidated Parent Plus loan, so if you just did a regular consolidation of them, only qualifies for that income contingent repayment plan, none other of the repayment plans, and it doesn't qualify for the public service loan forgiveness. However, if instead of consolidating them all at one time, you do a consolidation of two loans and 2 loans, so now you have 2 consolidated Parent Plus loans, and so we're at 4. We consolidated these 2, consolidated these 2. So now we've gone from all Parent Plus to 2 consolidated Parent Plus. Then you do another consolidation. And by doing that second consolidation, also nicknamed a double consolidation, you now turn those into direct loans. And taking advantage of the limited waiver, you may be able to draw in your past payments on those old Parent Plus loans into your loan and get that forgiven under public service loan forgiveness, even though they shouldn't have qualified in the first place. So that's a loophole there that may be for some borrowers that have Parent Plus loans that work in the nonprofit setting. Since the PSLF payments don't have to be consecutive to get forgiveness, would you recommend anyone who previously had PSLF apply for the waiver, even if they aren't currently working for a qualifying employer now? Just in case? Yeah, that'd probably be a good just in case. To do that, to make sure all of your payments were aligned and you were set up for the most forgiveness possible. It also may make sense to do that based on the income-driven repayment waiver as well, kind of in combination, because if you do it before October 31st, it will be under the PSLF and the income-driven repayment plan. So if you end up not going back to the nonprofit sector, you would still be able to qualify under the income-driven repayment plan. If you extended it out that long. Obviously, it's a longer repayment, but it would still qualify. All right. If we are getting close to PSLF, how often should we submit our employer verification? It seems like they're swamped from all of this, and it might take longer to get paperwork processed than normal. Once the pause is done, I don't want to be making payments over my 120. Yes, very good. So typically, you're going to want to file it when we recommend our clients to file once per year, just to get an updated account. Now, I know from FedLoan, I'm not familiar with Mahila's new website, but I know FedLoan kind of assumed that you were still within your current employer, so you would kind of see the count go up as you continue working. But you want that letter confirming your qualifying payments, and so we recommend once per year, typically with your recertification, because they will remind you of the recertification of your income when you recertify your income. Also, just recertify your public service loan employment, so they're forced to calculate those most recent 12 months and then be able to do that. Now, right now, so once the pause is done, I don't want to be making payments over my 120. After the pause is done, if you start making payments, any payment that you make over that 120, you will get refunded as well, along with the forgiveness. So you're okay in making those payments; those will get refunded. If anything's refunded immediately, or anything is forgiven immediately, you won't qualify for any refunding because you didn't make any payments over the last 3 months. And if you did, then you can just request that refund first and then apply for the forgiveness. If all my loans are with Mahila, do I have to consolidate them? Maybe. It depends on what the payment history count is going to be on those. Does your time in graduate medical education count towards the 120 payments if the loans were in deferment from undergrad? No. So you would have to be making payments on the loans to have them qualify. And so if you were in a period of deferment, so that also includes grace periods or deferment periods where you don't have to make payments on the loans, that timing would not qualify. Now it gets a little bit hairy over the last almost 3 years where we've been on a pause and no payment has been required. Technically, through the GME, you may be in under the university, getting paid through the university. And so there's a potential argument to be made there that time should potentially count, but I haven't seen guidance on that. Maybe some of my other fellow student loan experts that might be spying in on this call know that answer. Is there a list to refer to for qualifying employers for the PSLF? There's not a list that I know of. However, if you go to studentaid.gov/PSLF, that will bring you to their PSLF tool, which is it's a newer tool. And if you type in the employer identification number of your employer, and you click it and it'll come up with the employer, it will have a green check mark if somebody else has previously certified that through that organization. So if it's a smaller company, it may be yellow at first, saying we're not sure if this qualifies. It may be red to say, this probably doesn't qualify, or it may be green saying this most likely qualifies because other people have used this employer before and they've already looked into it. So that's a really helpful tool. So just because it may not be green doesn't mean it doesn't qualify. It may just be a smaller employer, but you do want to be careful with that to see exactly who your employer is, how you're getting paid, and if they're truly a qualifying entity. One weird stipulation I will mention for any physicians on the call or watching the recording is most physicians working in hospitals get paid through the hospital and are qualifying. Specifically in California, they have really, really weird laws. And most of the time when you're working actually in a hospital, you're not hired by the hospital itself. You're not allowed to in the state of California. And so your employment contract is with a private entity that then farms you out to the nonprofit hospital. And so although you're technically working in a nonprofit entity and working beside people that probably qualify, you do not qualify because your employer, who you get your paycheck from, is not the nonprofit itself. It's from a private entity. So in order to see who you qualify for, you really have to see who your paycheck comes from, and then that'll tell you whether or not the employment is qualifying. For the income-driven repayment plan, is that based on income of the individual or both spouses if married? Best to file taxes jointly individually. Great question. So one of the key strategies is under normal time periods when payments aren't set to zero. Payment is 0% interest. Obviously, to qualify for the most forgiveness possible, you want to pay the lowest amount possible until the loans are eventually forgiven. So that's the strategy. That's what we help people to design plans around so that they can pay the least amount possible, qualifying for the most forgiveness. So the question of whether or not to file taxes either individually or joint, that is going to change your student loan payment. In most of the payments. Again, a caveat. Again, revised pay-as-you-earn is a little bit different. Doesn't matter how you file, they're going to include both incomes. For the other repayment strategies, if you file your taxes separately, you can exclude spousal income from the calculation of your student loan repayment. But typically, you're going to pay a little bit more in taxes for doing that. Some people after they've recertified a couple times, we'll actually go back, because you can look back on your taxes 3 years. And Tricia is more of an expert on this than me, being the EA. But look back on your taxes for 3 years and actually file an amended return. You can switch from filing separately to joint to pick up any lost deductions that you might have had from that. As long as your last filed tax return is showing that separate, that's what the student loan system is consistently pulling. And so that's what you're going to be seeing. They're going to be seeing to base your payment on. And so people have, I don't know if that's an approved strategy or if it's illegal somehow, I don't know. But they have filed amended returns to pick up any lost deductions from filing separately to jointly. But just again, always keeping the most recent filed before your income recertification as that filed separate tax return. It also gets a little bit funky in community property states. So that's mostly on the West Coast. And if you file separately in community property states, your income actually gets split equally between the two, regardless of who earns it. So in a non-community property state, the income will be separated based on who actually earned the income in the relationship. In a community property state, let's say you have one person earning 100,000, one person earning 300,000. They actually combine it to 400,000, and then they'll split it up and file each as if they made 200,000. So that could be good for the physician that is in the community property state that's making a higher income, but not so good for the social worker that may be making the lower income, and that could actually hurt because you're pulling in a higher salary. So there's some unique strategies surrounding that. What is the disbursement date for people who had loans taken out in 2005? So the disbursement date is when the loans were actually dispersed, meaning given to you. And so those loans could be a number of different loans. There's a lot of different loans available in 2005. So you'd want to check on what type of loan it is. Assuming that it is in the federal system, you should be able to do a direct consolidation of that loan and bring it into all of the current benefits that we've been talking about tonight. If a student is still enrolled in college and has been making payments, should he fill out a limited waiver, request refunds, or both? Student still enrolled in college, been making payments. So still enrolled in college. So if your parents are under the income threshold, meaning 125,000 if it's single, 250,000 if it's married filing jointly or head of household. If they're under that, then you would qualify for 10,000 or potentially 20,000 if you also qualified for a Pell Grant. However, if you have, let's say, 30,000, let's go a weird scenario, you have 30,000 of debt at the beginning of the pandemic, you've paid down 10,000, you have 20,000 left, I wouldn't pay any more because that 20,000 would now get forgiven under Biden's plan. Now, if you had under 20,000 and you've been paying loans, obviously it's going to be suboptimal for you to have been paying on those loans. So you can request a refund. And as I said before, this is there's no guidance right now in terms of the requesting of the refund and whether or not that would be included under the plan. No downside besides your time. So you can request that refund and to get back up to the 20,000, assuming the Pell Grant scenario, and then get the full thing wiped out and keep your refund, keep the money that you paid. So there's some strategies surrounding that. Do Stafford loans count for Pslf or this 10,000? So Stafford loans, Stafford loans are type, but you really want to look for direct or FFEL. So you can have direct Stafford loan, and yes, it would count. And FFEL, I believe they had FFEL Stafford loans. They may count as well if they're federally held, but if they're not, you can consolidate them into direct loans and have it count for both Pslf and this most recent 10,000 forgiveness. All right, what is the max amount a high income earner could forgive if FFEL loans and using the consolidation pay you mentioned? Max high income earner could forgive up to their full amount of student loans. I had a surgeon in South Jersey have $86,000 forgiven earlier this year. They had all older FFEL loans. They were at 2.25% interest rate, so we never did anything. They just were paying the minimum payment. Now, those old FFEL loans that weren't held by the Department of Ed, they didn't qualify for the forbearance. So he was still making payments all through this time. But once this limited waiver came out, obviously advised him to do a direct consolidation, applied for everything, and those loans were forgiven. So if he had 300, 400, 500,000, those would all get forgiven. Yes, and assuming public service or doctor as in your example. Yep, so that's exactly it. Thanks, Jason. I have Navient and they won't give me a refund back except 12 months. Is that true? Maybe. The Department of Education is vague in terms but I believe they say payments since March of 2020. So I push back on Navient, assuming that these are federal loans, because Navient also has a private loan sector as well. So if it's private loans, there's really no reason to be, or truly private loans, there's really no reason to be requesting a refund anyway. But if they're federal loans, I'd go to the Department of Education's website. I would look at the stipulation that how they actually have it worded on the website. And I believe it says loan payments made voluntarily or via direct debit since the pause March 13th of 2020 can be refunded. So I'm not sure why they're arbitrarily saying 12 months. So I'd push back on that a little bit, but at the end of the day, I am not the ruler of the student loan. So that's what you may have to do. Would you please repeat the under 12K balance forgiveness on the proposed new IDR? Sure. And this is, again, just a proposal right now. This is not official or in place yet. This new income-driven repayment plan won't go into effect probably, if at all, or until July of 2023. I think in terms of just a side note, in terms of the court ruling and challenges, I don't think they can do much about the income-driven repayment plan because there's precedent there already, even before the pandemic, of having new plans kind of via executive order and the general rulemaking that they have surrounding student loans. So that probably is the most likely to go through without any issues, but still a chance it could not. So I just wanted to frame that. But if it goes through and you can start it in July of 2023, if you've made payments over 10 years within that plan, now the one question I'm asking myself is, because you can flip between different income-driven repayment plans right now. So if you have already 10 years of repayment under an income-driven repayment plan and your balance is under 12,000 and you now switch over to that new plan, does those time counts? We don't know that answer. But assuming that you're just graduating from school in, let's say, 2023 next year, and you start on that income-driven repayment plan day one, after 10 years, if your loan balance is under $12,000, then you'll get that long-term forgiveness, even regardless of if you're in a public service or not. So that's under the new proposed IDR. Under 12K, any balance above that, you would extend, I believe, that new IDR is still under the 20-year forgiveness as well. What happens if the court strike down the loan cancellation, even though you fill out and submit the income form in October? Then nobody gets the cancellation. The courts, if they judge that it was an overreach of executive power, and that the Biden administration does not have the authority to do it, then he wouldn't have the authority to do it, and it wouldn't get canceled. And so that is a real risk right now, especially if the Republicans can garner up enough of a hubbub to take that to the courts. Clearly, not getting into too much in terms of politics, it's not going to look very good for them going into the midterm elections, and the timing of Biden in doing this is impeccable. So I feel like there is some political agendas behind the scenes here, obviously helping a tremendous amount of people, not debating that. But in terms of the timing of this announcement and everything, right before the midterms, getting a bunch of support now from the Democratic side. So if it goes through, great, everybody's happy. And if it doesn't go through, then it was the Republicans that caused it not to go through in the courts. And so it's, tails, I win, heads, you lose kind of a deal here. And so pretty good move, political move from the Democratic Party, if you look at it from that standpoint. Will forgiveness be applied to interest or principal first? So forgiveness will probably be applied to interest first. So whenever you make a payment, assuming you're on an income-driven repayment plan, there's an order that your payments need to go. So first off, I want to bust the myth right now that the student loan interest compounds, because if done correctly, it does not compound at all. It's actually a simple interest, because that interest bucket, it's a separate bucket, and it does not accrue interest. Only the principal balance accrues interest, and then it flows into this interest bucket. Now, there are certain circumstances that the interest will capitalize into the principal balance, and then now it is compounding. But assuming that you do everything right, which is a complicated system, that there's really it shouldn't be compounding of interest. Now, If you have those two separate buckets, the interest bucket and the principal bucket, when you make a new payment, it gets applied to interest first. And so until you make payments and eliminate that interest, you can't actually access the principal of the loan until that interest is eliminated. And so any forgiveness would probably go towards, if it follows that same pattern under the income-driven repayment plans, it would flow through towards interest first and then flow through towards to principal. I haven't seen any official document on that, but that just makes sense in terms of how the loans work. If one worked full-time for a nonprofit while also being a full-time student, so loans were in school deferment, does this qualify for public service loan forgiveness? So that's kind of a similar question to before in terms of being in school and on deferment, not paying towards your loans. In normal times, that does not qualify. During the COVID-19 pause, I have not seen any true assessment on that. Whether or not it does qualify, since your payments are supposed to be zero anyway. So that would be an interesting thing to try for, but I have not seen it either way. So I can't really talk on it. With the new payment plan, interest will not be added to your loan that is not covered by your yes. What if there is still interest left over after the 10,000, 20,000 were given? Will that also be forgiven just like future monthly interest will be? No. So this is a great question and one of the more intricacies of the income-driven repayment plan. So one of the little known facts about the income-driven repayment plan is there's built-in subsidies now, meaning that if you're under a revised pay-as-you-earn plan and you have and you don't pay all of your interest, let's say your payment is zero and the interest that's accumulating on your loan is supposed to be $1,000 per month, actually $1,000 per month will not accrue. If it's subsidized loans for the first 3 years, 100% of that is actually wiped out. So there's no interest getting added into the loan of those subsidized loans while you're not covering the interest for the first 3 years. And that extends for all plans. Then specifically for revised pay-as-you-earn plan, for even unsubsidized loan, this is the only income-driven repayment plan before this new proposed one that has an interest subsidy built in of 50% of the loan interest. So only 50% of the loan unpaid loan interest will actually accumulate in that bucket. The other will be waived. They took it one step further in this new income-driven repayment plan. So what they're basically saying is that if your payment is not high enough to cover the interest, none of it will build up. So basically, you won't have any interest. They're basically taking away that interest bucket. So you'll only have principal all the time if you're under this new income-driven repayment plan. And so that's one of the potential big benefits of it. If there's still interest left over, if the 10 or 20 forgiveness, will it also be forgiven? No, that would probably stay there. Any new interest wouldn't be allowed to accrue if you're in that plan. But by switching, so in order to get into that plan, assuming that there's not a different rule, you have to cap it. So that's one of the situations when you change income-driven repayment plans, that's when the interest goes into the principal balance. So in order to get into that income-driven repayment plan, unless there's some other thing that announced that allows you to somehow maintain that interest bucket without it actually capitalizing, your loans will be all principal when you enter that plan, and then no interest would accrue going from there, but you would still have a larger principal balance at that point in time. But great question. If all my loans are with Mahila, do I have to consolidate them, or are my payments already consolidated since it's with the same service? By the way, thanks for doing this. Thank you for being on. I truly, truly appreciate all of you that are even still on this call, an hour, 10 minutes in. And it is just incredible. Hopefully I'm bringing tremendous value here. So all the loans are with Mahila. Do you have to consolidate them? Again, that answer is maybe. You're going to have to dig into the payment history of the loans and also what type of loans they are. So Mahila can still hold the FFEL loans. And so if you have them, you would want to consolidate those FFEL loans and most likely consolidate everything together to match all of the payment histories and get the longest qualifying there. If you apply for an IDR plan, should I wait to submit the Pslf certification until the IDR paperwork has been processed at Mahila? Should I wait? So I'm going to take this question as if you're applying for the waiver. You should wait. You should wait until your loans consolidate before applying for the Pslf certification. So in the case study I had before, where the social worker had 74,000 of undergrad loans, 104,000 of graduate, if they would have just submitted the Pslf paperwork before doing the consolidation, the 74,000 would have gotten wiped out, but now she's going to be left with 104,000. that she would then have to do. So doing that consolidation first matches all of the payment histories, and then that's what allowed the full $178,000 to get forgiven. So if we're talking about the IDR plan, that really doesn't matter. So any plan, any payment pretty much towards a student loan, even if it's not an IDR plan, if you're going for the waiver, counts. But going forward, you want to make sure that you're under a qualifying IDR plan, because after October 31st, there's no, unless they extend it, which I guess they in theory could, but there's no room for error after that. Should I consolidate loans now if I am currently in my 6-month grace period? So it depends. You can. So a consolidation, you can skip your grace period under a consolidation, and you would do so if you're working in a nonprofit entity, and we're going to go for that 10 years of repayment. So you probably can have the 10 years, that clock start soon, and assuming that you had a 0 income from last year and filed a tax return, you can pull that income, and your payment would be 0 still anyway. So you waive the grace period, your payment's still 0 for that first year. Typically under PSLF, we recommend that. Under IDR, it will depend. Under this new IDR, there would be no ramifications for doing that, because no interest would accrue. Under any other IDR, it may or may not work out in terms of if you're going for the long-term forgiveness. Is Biden administration only covering up to $20K for people who took loans from 2010? What happens to people who took loans in 2005? No, so loans in 2005 could potentially count, assuming they're the right type. The 2010 loans, that's when they stopped issuing those older type of FFEL loans. So everything was direct or Perkins after 2010. Then they eventually stopped Perkins, I think, in 2014. And so in looking at that, those loans could potentially qualify if consolidated into direct loans, and they allow it post consolidation, which they should, but no guarantees there. Any advice on logging into studentaid.gov? I do not remember the login. I've attempted with what I thought it may be. You could just reset your password like any other type. An issue may come in if you no longer have access to the email that you initially signed up with studentaid.gov. That could be a potential issue. And then I think, unfortunately, you'd have to try to call them. And right now, that would probably be impossible to do. So I would try to go through the reset password link, try to do all of those different secondary verifications to try to get just the password reset. And if you can maybe pull back an old email that you might have signed up for it, that may be the easiest way, and then update your information. That's one of the other important things, is to make sure that on all of these websites, especially studentaid.gov and your servicer, that all of your contact information is up to date, because that's how you're going to learn of the different forms that you have to fill out for the forgiveness. If your information is out of date, they may send the form and your notification to the old email address. And if you're not tracking that and you miss it, you could miss out on the forgiveness even if you qualified. So you still have to apply for this 10,000 cancellation or up to 20,000. So you definitely should be looking out on that. All right. Does the PSLF waiver still require employment to be at least 35 hours / full-time employment? So it does still require full-time employment, but that is set by the employer. So if they consider you full-time, working 28 hours a week, then you're full-time. But typically they're going to require, there's going to be more hours. Or if you work in 2 employers that are both part-time simultaneously, if you're over 30 hours in a week, that also, you can put the 2 together, and that could qualify for employment. But if you're solely part-time, that time doesn't count, because you're only part-time. You have to be working pretty much the one stipulation for the Public Service Loan Forgiveness Limited Waiver is you have to be working full-time or have the 2 part-time equivalents during that qualifying employment. If you don't have that, then all of the different things don't matter, the right type of repayment, the right type of loans, etc. So thanks for that question. If I don't have an income-driven repayment plan, paid loans monthly, had my payments waived because of the payment freeze the past 2 years, and received Pell Grants in college, is there anything that I could do that could still disqualify me from receiving loan cancellation, assuming I fill out the income form that would be available in October? The only thing that could disqualify you based on that would be if you made too much income. So $125,000 if you're single, $250,000 if you're joint. But that sounds like you would qualify for 20,000 based on me, based on what I'm reading. Sorry if you may have answered this. That is okay. I'll answer all questions. Is the cancellation based off of your income at this moment when applying for forgiveness or last year's returns? So I did talk about this at the very, very beginning. So if you join late, not a problem. I will now answer this for the ending call people. And again, congratulations to you for sticking around and listening to this and me talk for an hour and 15 minutes. I don't know if my wife can listen to me talk for an hour and 15 minutes. So I congratulate you on taking these steps. So the cancellation is going to be based off of your income in either 2021 or 2020. So if you're qualifying in one of those tax years, we still don't have clarification on what income that they're going to use. I mentioned at the beginning of this call, most likely it will be adjusted gross income, your AGI, which is line 11 on your 1040, either in 2021 or 2020. Has been talks of potentially using taxable income, which actually allows either your standard deduction or your other itemized deductions to count before calculating that, which actually would include a lot more people. But there's no precedent of using that. It's typically been adjusted gross income. And so that's what I would assume at the moment until more details come out from the administration and Department of Education. I've worked in public service since 2016 and I made payments since 2005. And apparently I have an FFELP, perfect. My remaining loan is about $6,800. Now, that being said, I can go on forbearance for the past 12 months and they will refund me only 12 months. Should I do it in this case? Probably yes, get those 12 months of a refund. And then what you're gonna do is take that FFEL, consolidate it with any of your other loans to pick up all of those to pick up the most amount of payments possible. So working in public service since 2016, you're still going to have some time where after the loan payments restart and to qualify for the full forgiveness. And then the strategy there is going to pick the right income driven repayment plan that's going to lead to the lowest payment possible and allow for the most forgiveness. Again, taking into consideration whether you're married or single, filing separately. And if this new income driven repayment plan comes into force, that would be an attractive one. I think I did it. Thanks for the information. We appreciate it. Thank you so much, Teresa. All right, so we've got 39 people still on this call, and incredibly, plus our beautiful 4 other panelists here. So I want to open it up to the panelists. Do you guys have any questions, anything you've seen? Thanks for sticking around. If you want a personalized plan, reach out to me. So reach out to my email, justin.rice@personalwealthstrategies.com. David, maybe if you can put that in the chat to everyone so they can see it, and then they can contact me. Obviously, there's a lot of potential demand here. And if you go try to schedule something in my calendar right now, my September is already fully booked. But if you email me, I will get a student loan plan to you eventually. It may just not be through me. But I do want to make sure that if you want specific help, that we can get you that specific help. So justin.rice@personalwealthstrategies.com. Send that email to me, and I'll sort it through and get you hooked up with a plan. The student loan plan is $750, and that would cover me. If I can't do it and I can't reach the demand, I will refer you to another beautiful professional that has just as much knowledge as me, and I believe that's a little bit cheaper as well. I believe their consults are $595 for a 1-hour student loan consult. But I will get you help if you want that additional help to make sure that you are maximizing forgiveness of everything that I just talked about over the last hour, 20 minutes. So
Justin, we have a couple more questions that are in the chat. I don't know if you can see them or if you want us to read them to you.
Yeah, if you could read them for me. I can kind of see the chat, but it kind of got really, really long away. So if you could read those, that would be helpful to me. Perfect.
Absolutely.
I got it, Trishette. When will income verification begin once payments restart in 2023?
So that's going to depend. It should already be updated on the studentaid.gov website. So it should be located there. The latest FAQ I've seen is that it wouldn't be at the earliest, it would be in May, but that may get pushed back as well. It could be, July. I've seen July for some people. So it's going to be they're going to basically calculate it from when you would have recertified before and then bring it up. So just keep an eye out for it, because you definitely don't want to miss that, because if you miss your income recertification, you get flipped back into the standard plan. So your payment is going to go up. You're going to pay more than you should be, and then you have to flip into a forbearance, then go into an income driven repayment plan, and your interest would capitalize. So that would not be a good situation. So you do want to make sure to recertify your income when that is due, but no sooner. Yeah, next question.
Another question from Sarah: is there an income-based repayment action plan? Oh, Parent Plus, sorry. Under the public service loan repayment, does volunteer service running rescue count towards that program?
So volunteer service does not count as far as I am aware. There may be some certain circumstances where you can make it qualify, but as far as my understanding, if it's volunteer and you don't get paid, even if it's you somehow are a full-time volunteer, then that would not be a qualifying, because you wouldn't have made qualifying payments during that time. So I don't think that would qualify, but definitely verify that as well. And if you hired a consult and we have specific questions like that, we dig obviously the deepest that we possibly can into the depths of the student loan rulings so that we can get you the maximum possible forgiven.
Another one. Do you mind clarifying whether I should or should not consolidate all my Mohila loans? I have 2 years undergrad and 2.5 years grad. Thank you.
Maybe. So it's going to depend. So if everything is under the same repayment schedule and your income has shot up over the last several years, it may hurt you to consolidate, because you're going to have to recertify your income earlier than you would have otherwise. And so your payment, when the payments restart, are going to be higher. However, if your payments are not matching up with the various loans, consolidating them matches the payment with the longest loans. So even under that circumstance, if it raises your the payment, it may be worthwhile to consolidate. So you'll just have to kind of do some math and projections there to see if it's worth consolidating or not, based on what your income was in that you filed in 2021 versus what your repayment would go back to based on when it stopped in March of 2020, and then how many new payments would get included in those other loans. So it's a calculation, but I can't do that on this call.
A question from Nancy: does working as a veterinarian consider public service?
Most likely not. Most veterinarians that I know are working in for-profit veterinary hospitals, but that doesn't mean that nonprofits don't exist. So just check with the studentaid.gov. So when you go to studentaid.gov/PSLF, you'll have your employer identification number there that you can pull from, should be on your W-2 if you check that out. You put the employer identification number in, and that way we'll see if other people from your organization have qualified for public service loan forgiveness and if it is a qualifying entity.
Can you file an extension for 2022 taxes and use 2021 taxes if you have to recertify in May 2023?
Yes.
Just so I'm not confusing things, I had been told to always avoid consolidation because it resets the clock of qualifying payments. Does it not reset the clock?
Before October 6th, 2021, it absolutely reset the clock, and you definitely did not want to consolidate your loans, because then you would have wiped out all of the repayments and you would have restarted the 120 repayment clock. So definitely a bad move prior to October 6th, and will still be a bad move after October 31st of 2022 this year. However, during this time, under the limited waiver, consolidating the loans, they're allowing to count those past payments to break that seal of the consolidation, which typically would have wiped out past payments. They are now allowing those to count, so they'll pull those in. And as an extra bonus, they'll also use the longest payment history of any loan. So if you have one loan with 120 payments already, that's only $1,000 of debt outstanding, and you have $1 million of student loan debt that only has 1 year of payments counting, you consolidate them all. That 1,000 will get transferred to the whole thing, and the whole thing will get wiped out for public service loan forgiveness.
Hypothetical scenario: a divorcing father who's cash strapped due to intermittent income from bonuses which loan option should be taken between either a direct plus or a private loan in today's environment, please?
So I would always go federal loan. So that would be the direct plus loan. I would not go private during this climate, or probably ever, unless things drastically change. The student loan program, although it does have its faults and its complications, is the most generous loan program in the United States. With all of the different, forgiveness plans and strategies and repayment plans, it is the most generous. It's also the most confusing, which creates problems, but it is still the most generous. So when people complain about it, they're complaining that it's complicated, but it's definitely not that it's not generous, and it's even getting more generous now. But in order to take all of this action, you still have to pay attention. You still have to act. It's just not going to happen for you under most circumstances. You have to do something in order to qualify for this. And if you want to maximize your forgiveness, that's why it may be worthwhile to have that consolidation or consultation, so that you can get the maximized forgiveness.
Last question in the Q&A. And you may have just answered this, if I consolidate, do I still qualify for income-driven payment?
Yes, under a direct consolidation, you do still qualify for income-driven repayment plans. And yes, that is it. And you can choose your repayment plan under the consolidation. So that is a good strategy most of the time.
And that is it.
Wow. Thank you so much for everybody who has joined the call. David, Trisha, Beth, Kepa, any things that I should know, do, or are we good to have me go home and meet with my wife and twins?
I think
Justin,
this
I would
is-
highlight the fact that this was all recorded and will be posted up on the YouTube channel. And if you like, maybe plug for some future webinars that we have.
I got you. Thank you for the reminder. I knew that was going to happen. So if you stuck around this long, you like our webinars, you like our value, we do have more of these coming, not specifically student loans, but a bunch of other topics. Our next one coming up is sustainable investing. We're going to have Larry Swedrow and Sam Adams join us next week, Wednesday, September 7th at noon. So make sure to you can go to our website, personalwealthstrategies.com/events. And get all of the information there and register. The October webinar that we're going to be doing is estate planning basics. What documents do you need? What documents don't you need? With an attorney, Keith Singer. And that's going to be October 12th, again at noon. And then in November, we've got choosing the right providers for your extended care with Nancy Dykman. And that is going to be November 9th. Also at noon as well. So that's kind of our webinar lineup that we've got coming. Tremendous speakers as well. So you won't just have to hear my voice the whole time. And we hope that you can come join us for that.
Thank you so much, Justin. I really, really appreciate you doing this. The fact that we still have 33 people on an hour well into this, it's pretty amazing. So just how much wealth of information you have and how much people need it. So.
Well, thank you so much, Trisha. I thank you for encouraging me to do this. A little bit out of my comfort zone. I was mentioning before at the beginning of the call that I've never done any presentation without slides. I've always had some type of slides, and I was just going to kind of go based on everything in my noggin here, just because it was such a quick turnaround since the announcement. And hopefully it went well, and I provided a ton of value for everyone. That's what I'm always looking to do, just provide the absolute most valuable possible. But thank you, Trisha, for the inspiration, because without you, this probably does not happen. So I appreciate you. And I appreciate Beth for kind of working behind the scenes here. So I will actually look at this. Spotlight Beth. Yay, Beth. And I hope to see you. I hope this is just the beginning of our relationship here for any attendees and people on the call. Thank you so much.